Right now, silver is sitting at one of the most pivotal crossroads it has faced in years. And if you are not paying close attention to what is happening in Washington and Tehran this week, you could be completely blindsided by what comes next. We are talking about a metal that went on one of the most explosive runs in modern market history, surging 145% throughout 2025 to smash through a nominal all-time high of around $121 to $122 per ounce in late January 2026. And then, in a matter of weeks, it gave back more than 40% of those gains, crashing down into the low 70s. Today, on this Good Friday session with U.S. markets officially closed, silver is quietly trading around $73.75 per ounce. Quiet on the surface, but underneath? This market is a coiled spring, and the single biggest trigger sitting right in front of it is the possibility, very real, very live, of a US-Iran diplomatic deal happening this week. Let me walk you through exactly why this matters, what it means for silver in both directions, and what levels every single silver investor needs to have circled right now. To understand where we are, you have to understand what has been driving silver's wild swings over the past 2 weeks. On April 1st, President Trump delivered a televised address pledging to escalate military operations against Iran. The market reaction was immediate and brutal. Silver dropped approximately 5% in a single session, falling to around $71.26. To put that in perspective, gold fell somewhere between 2.3% and 2.8% during that same period. Silver got hit nearly twice as hard. Why? Because silver has a dual identity that makes it uniquely vulnerable to this kind of geopolitical shock. On one hand, silver is a monetary metal, a safe haven like gold. On the other hand, it is a deeply industrial commodity. When you get a geopolitical escalation in the Middle East, especially one involving Iran and the Strait of Hormuz, you get a cascade of negative forces hitting silver all at once. Oil prices spike, inflation expectations rise, the Federal Reserve is forced to stay tighter for longer, real yields go up, the US dollar strengthens, and every single one of those forces is a headwind for silver. So while gold can absorb a geopolitical shock and even benefit from safe haven flows, silver gets crushed from multiple angles simultaneously. That is the brutal reality of owning this metal in an environment like this one. But here is where it gets interesting. Just days after that military escalation speech, a Wall Street Journal report surfaced suggesting that Trump was actually open to a diplomatic resolution with Iran, and silver ripped more than 5% in a single session, bouncing right back up to approximately $70. In days, it gave back what it lost, and then some. That kind of sensitivity to a single news headline tells you everything you need to know about where the real pressure in this market is coming from right now. Geopolitics is the dominant force, and a genuine deal with Iran would not just remove that pressure, it would flip it into a tailwind. So let us walk through what an actual US-Iran diplomatic deal would mean for silver, dimension by dimension, because this is not a simple story. It cuts across multiple macro variables all at the same time. Start with oil and inflation. A credible deal, one that eases the threat of Strait of Hormuz disruption, would almost certainly push oil prices lower. Lower oil means lower energy costs across the entire economy, which means softer inflation data in the months ahead. And softer inflation means the Federal Reserve has more room to breathe. Now here is the specific number you need to know. Analysts have been watching the 10-year U.S. Treasury yield, and the critical threshold sits right at 4.3%. When the 10-year yield is above 4.3%, it acts as a significant headwind for precious metals. When it drops below that level, silver historically performs well. A de-escalation in Iran that pulls oil prices down and eases inflation expectations could be exactly the macro catalyst needed to push that yield back below 4.3%. And if that happens, silver gets a green light. Now add the US dollar dimension. When geopolitical tensions ease in the Middle East, the safe haven bid for the dollar fades. Investors who piled into greenbacks as protection start unwinding those positions. A weaker dollar is directly bullish for silver, because silver is priced in US dollars through the XAG-USD pair. A falling dollar means every ounce of silver is worth more in dollar terms, all else being equal. So a deal does not just remove one headwind, it potentially turns both the yield dynamic and the dollar dynamic from negative to positive at the same time. And then there is industrial demand. This is the part of the silver story that does not get enough attention in the geopolitical conversation. Silver is consumed in massive quantities by solar panel manufacturing, electric vehicle production, 5G infrastructure, and dozens of other industrial applications. These industries are energy intensive. When oil prices are high and energy costs are elevated, it squeezes the economics of manufacturing broadly and can slow capital deployment in sectors like solar. A deal that brings energy prices down is not just a macro story, it is a direct tailwind for the industrial demand side of silver, which is already running at record rates. Global silver demand is estimated at over 1.2 billion ounces annually, and the market has been in supply deficit for 5 consecutive years. That structural backdrop does not go away because of geopolitics, but cheaper energy would accelerate investment in exactly the industries consuming the most silver. Now, let us bring in the broader macro picture, because the Iran deal does not exist in a vacuum. The March 2026 non-farm payrolls report came in at 178,000 jobs, dramatically above the consensus estimate of just 60,000. That is a monster beat, and a strong labor market print like that pushes back Federal Reserve rate cut expectations significantly. When the market was pricing in rate cuts, silver had a tailwind. Now that those cuts look further away, silver has a headwind from monetary policy on top of the geopolitical pressure. A diplomatic deal with Iran would not erase that headwind. The Fed is not going to cut rates just because tensions with Tehran ease. But what it would do is remove the most acute near-term source of downward pressure, the inflation risk premium and the geopolitical fear premium, that has been the dominant force suppressing silver since its January highs. And that matters enormously. Think about what that combination looks like. The Fed is still on hold, but geopolitical risks are actively easing, oil is coming down, the dollar is softening, and industrial demand remains structurally strong. That is actually a unique sweet spot for silver. It is not the same as a full-blown rate cut cycle, but it creates the conditions for a meaningful recovery from these $73 levels. Let us talk about the technical picture, because the chart is telling a very specific story right now. Silver's ability to hold above $70 per ounce is absolutely critical. That level has been tested multiple times and has held as a floor. Every time it has approached $70, buyers have stepped in. That tells you there is real demand at these levels. To the upside, the first major resistance zone sits at 77.96 to 78 €. That is the level silver needs to clear and hold above in any post-deal rally scenario. A sustained close above $78 would open the path toward approximately $85 as an intermediate recovery target. The RSI is sitting around 46, not oversold, not overbought, just coiled. The MACD has turned bullish. These are not screaming buy signals, but they are telling you the metal is positioned to move hard when a catalyst arrives. And a diplomatic deal is exactly that kind of catalyst. So let us paint both scenarios clearly, because you need a plan for both. In the deal scenario, here is the likely sequence. Iran headlines break positive, oil prices fall, Treasury yields ease back below 4.3%, the dollar softens, and silver breaks above the $77 to $78 resistance zone within days. Once that happens, momentum traders pile in, ETF inflows accelerate, and we are talking about vehicles like the iShares Silver Trust, which currently holds $46.2 billion in assets under management, and the path toward $85 opens up quickly. Beyond that, if the macro backdrop aligns with easing Fed expectations later in the year, the longer-term institutional targets of $118 to $130 come back into play. JP Morgan has a 2026 average price forecast of $81 per ounce for silver. A deal scenario could pull that average significantly higher. In the no deal or deal collapse scenario, the risk is a breakdown below the $70 support floor. If $70 fails to hold, the next meaningful line of defense sits in the mid-60s, around a $66 retracement level. That would be a painful outcome for silver bulls. But here is the critical distinction. A move to $66 would be a short-term technical breakdown driven by macro fear. It would not be a structural collapse of the silver bull case. The supply deficits are real. The industrial demand from solar is real. China's imposition of silver export controls in December 2025 has tightened the global supply picture in a way that does not reverse because of a geopolitical headline. Each solar panel requires approximately 20 grams of silver, and solar demand alone is expected to nearly double between 2020 and 2030. None of that changes based on what happens in US-Iran negotiations this week. Which brings us to the most important point of all. Silver at $73.75, after touching $122 just months ago, is a metal that has already proven beyond any doubt that it can move with extraordinary velocity in both directions. Anyone who bought silver in early 2025 at $30 and held through January 2026 made over 300% on their investment. Anyone who bought near the top and is still holding is down more than 40%. This market does not reward passive observers. It rewards people who understand the variables, watch the catalysts, and have a clear plan. Right now, the Iran deal question is not just a foreign policy story. It is the single most important near-term variable for the silver price, sitting right at the intersection of oil, inflation, Federal Reserve policy, the US dollar, and global industrial demand. Every one of those channels runs directly through what happens or does not happen in negotiations this week. Whether a deal gets done or falls apart, silver is not going to stay at 73.75 quietly for long. This market is going to move, and it is going to move fast. So here is what I want you to do. Know your levels. Watch $70 on the downside and $78 on the upside. Have a plan for both scenarios, and stay close, because this story is developing in real time. If you found this breakdown useful, hit the like button. It genuinely helps more people find this content. Subscribe if you are not already, because we are going to be covering this Iran deal situation and its impact on silver and gold every step of the way. And drop your silver price prediction in the comments. Where do you think this metal goes if a deal gets done this week? I want to hear from you. Let us talk about it.